Welcome back, everyone. We all know that stocks move up and down. Sometimes they give you great returns, and other times they do not. But did you know that if you look hard enough, you can find a few needles in the haystack? I'm talking about stocks that consistently deliver market-beating returns. There is no stock that will beat the market every single day, or even every week, or month for that matter. But we are told that we should invest money we won't need for the next 5 years, because the stock market can be volatile, and it does correct every 2 years or so. If we are told to invest for a minimum of 5 years, should we not also measure the success of our investments over the same 5-year period? I found 5 dividend stocks that have a perfect record of outperforming the S&P 500 over all 5-year rolling periods since their inception. Let me tell you who they are and how well they have performed relative to the S&P 500. And maybe instead of investing in the next hottest thing, you can think about investing in the things that have worked great in the past. We will look at the current streak of outperformance, measured by rolling 5-year periods updated monthly, the worst, best, and average 5-year return for each stock, and the worst, best, and average margin of outperformance each stock has delivered over the S&P 500 index. I'll start with the company that has the shortest winning streak, and we will work our way out to the longest winning streak. First up on this list is none other than Zoetis, ticker symbol ZTS. The company went public in early 2013, so we have full monthly data between February 2013 and January 2024, giving us 132 months of returns, and this also gives us 73 5-year rolling periods. On average, Zoetis has returned 1.61% per month, relative to a 1.13% return for the S&P 500. That is a 42% better return. In this chart, you can see the rolling 5-year returns for Zoetis in green, juxtaposed with the rolling 5-year returns for the S&P 500 in blue. We can see that between 2018 and the beginning of 2022, the difference in the rolling 5-year returns between Zoetis and the S&P was pretty substantial, anywhere from 100 to 200% more. Then in 2022 and 2023, the returns began to converge, and in late 2023, this perfect winning streak almost came to an end. The keyword here is almost. Zoetis was able to recover in the past few months and start building a cushion in its rolling 5-year return. Not a big cushion, but nonetheless, it is trending in the right direction. In the second chart, we can see the margin of outperformance Zoetis was able to deliver relative to the S&P 500 for each of the 73 5-year rolling periods. Currently, the margin sits at an all-time low, around 20%. But at its peak in mid-2021, the margin of outperformance nearly reached 270%. Let's take a look at the actual numbers. Zoetis has the shortest streak of the 5 stocks I will cover today, at 73 months of beating the S&P 500 in rolling 5-year returns. The worst 5-year return for the stock has been 77.39%. The best return was 399.36%, and on average it has returned 213.3%. These are pretty solid rates of return over a 5-year timeframe. Looking at the margin of outperformance relative to the S&P 500, the lowest margin was 18%, and that is actually the data point following January 2024. The best margin was 262.91%, and this data point came in after December of 2021. And on average, Zoetis has delivered outperformance of 128.66%. As the stock is currently sitting at its lowest level of outperformance relative to the S&P 500, it'll be interesting to see how long it can sustain its perfect winning streak. January was a pretty sour month for Zoetis, as it fell by 4.63%. Meanwhile, the S&P gained 1.67%. For context, I am using the Vanguard S&P 500 Index Fund as the proxy for the actual index return. Also, just because the stock underperforms the index during a single month doesn't necessarily mean that its margin of outperformance will shrink, or vice versa. It's actually 2 months that play a role on the margin calculation, the newest month and the month that drops off. Alright, moving on to stock number 2. Broadcom, ticker symbol AVGO. The company went public in late 2009. It originally had a different name than Broadcom, but you can Google its history if you're interested to know more about that. We have full monthly data between September 2009 and January 2024, giving us 173 months of returns, and this equates to 114 rolling 5-year periods. On average, Broadcom has returned 2.97% per month, relative to 1.15% for the S&P 500, so more than double the index. In the chart here, we can see all of the rolling 5-year returns for Broadcom in green, juxtaposed with the rolling 5-year returns for the S&P 500 in blue. As you can tell, it was a pretty bumpy, but fruitful ride. The level of outperformance has been astonishing. Between 2014 and 2018, it ranged between 300% and as much as 700%. Then heading into the pandemic, it almost looked like Broadcom's streak would come to an end, but the stock recovered and bounced back to a modest level. Then once more in late 2022, it looked like Broadcom was losing steam, only to bounce right back in 2023. The range of outperformance in this chart has been so wide that these low points actually look worse than they really are. In this chart, you can see the margin of outperformance relative to the S&P 500 for each of the 114 5-year rolling periods. As you can tell, the two low points in 2020 and 2022 were not that bad at all. Broadcom still maintained a healthy 50% level of outperformance over the S&P 500. At its peak in November of 2017, Broadcom's 5-year rolling return exceeded the S&P by more than 700%. That is pretty phenomenal. Alright, let's take a look at the data table. Broadcom has the second shortest streak out of the 5 stocks I will cover today, currently standing at 114 months of outperforming the S&P 500 based on rolling 5-year periods. The worst 5-year return for the stock was 110.41%. The best return was an amazing 813.28%, and on average it returned 399.76%. Taking a look at the margin of outperformance relative to the S&P 500, we have the lowest margin at 52.68%, the highest margin at 705.91%, and on average the margin was 310.56%. Very healthy figures here from Broadcom, as its streak is nearing a full decade now, just another 6 months to go. Following January, Broadcom's 5-year rolling return stands 338.94% ahead of the S&P 500, so I think it's pretty safe to assume we will see this streak continue for many more months. Let's move on to stock number 3, Visa, ticker symbol V. The company went public in early 2008. I have monthly return data between April of 2008 and January of 2024, giving us 190 full months of returns, and that equates to 131 rolling 5-year periods. On average, Visa has returned 1.79% per month, relative to 0.95% for the S&P 500, a very strong average and pretty close to double that of the index. In the chart, you can see all of Visa's rolling 5-year returns in green, juxtaposed to the S&P 500's rolling 5-year returns in blue. The level of outperformance started very well and continued steadily up until about the time of the pandemic. Following the pandemic, the rolling return started to converge, and for the last 9 months, it almost looks like Visa's streak was about to come to an end. It may be hard to see in the chart, but the green and blue lines have not crossed yet. This next chart shows the margin of outperformance relative to the S&P 500 for all 131 5-year rolling periods. As you can see, the margin was pretty strong between 2013 and 2020, oscillating in that 75% to about 200% range. But since 2020, the margin has declined and currently looks very low. Let's take a look at the data table. Visa has the third longest streak out of the 5 stocks I will cover today, standing at 131 months and on the verge of ending actually. The worst 5-year return from the stock was 61.97%. The best return was 375.8%. And on average, the return was 208.07%. All very healthy figures. The lowest margin of outperformance has been just 1.67%. The highest was 269.38%. And on average, it has been 118.23%. Following January, the margin is sitting at 4.98%, so it's improved a little from its lowest point in September of 2023. But this streak could come to an end very soon if Visa has a crappy month or two. Alright, let's move on to the stock with the second best winning streak, and that stock is MasterCard, ticker symbol MA. The company went public in mid-2006. I have full monthly return data from June of 2006 through January 2024. Giving us 212 full months, and that equates to 153 5-year rolling periods. On average, MasterCard has returned 2.59% per month, relative to 0.89% for the S&P 500. A very sizable difference here. In the chart of the 5-year rolling returns, we can see that MasterCard started out very nicely with a sizable outperformance over the S&P 500. This sizable lead did however fade in 2012 and 2013, with the margin of outperformance shrinking from a high of 600% down all the way to about 60 to 70%, which is still a pretty healthy level of alpha. In 2013 and 2014, the outperformance improved and the margin grew. Since 2014, it has remained pretty flat, in the range of about 1 to 200% ahead of the S&P 500. And more recently, since about 2021, the margin has shrunk. On the tail end of 2023, it almost looked like the winning streak would come to an end, as the margin for the 2 rolling returns almost crossed. If we look at the actual margin chart, we can see the same trends, but it's important to note that while the margin has shrunk recently, it still remains at a reasonable level, right around 30%. Some of the very wide data points make the narrower margins look worse than they actually are. Let's jump over to the data table and look at the best, worst, and average figures. MasterCard has the second longest streak of the 5 stocks on today's list, currently standing at 153 months. That's nearly 13 years of rolling 5-year returns, during which this company has bested the S&P 500. Very impressive. The worst 5-year return was 74.01%. The best return was 630.56%. And on average, the 5-year return was 251.44%. The worst margin of outperformance relative to the S&P was 17.96%. This occurred fairly recently, in October of 2023. The margin has since improved and stands at 35.86% following January 2024. The best margin of outperformance was 624.54%, and this was the 5-year period, ended in August of 2011. And on average, the margin of outperformance has been 173.57%. Finally, let's take a look at the company with the longest winning streak, and that company is none other than Accenture plc, ticker symbol ACN. The company went public in mid-2001, giving us 270 full months of returns and 211 rolling 5-year periods. That's a little longer than 17.5 years of beating the S&P, a very, very excellent winning streak. Looking at the rolling 5-year returns in this chart, we can see that there were several times where the winning streak was at a risk of ending, but Accenture ultimately prevailed and has continued winning for almost 2 decades now. The chart showing the margin of outperformance gives us a better idea of how low some of these data points were. It looks like the narrowest margin took place sometime in early 2007, and since then, the margin has never dipped below 20%, a pretty respectable threshold to maintain. The average monthly return from Accenture since inception was 1.57%, relative to 0.76% for the S&P 500. That's right about twice the rate of return from the stock compared to the index. Let's jump over to the data table and look at the figures. Accenture has the longest streak of the 5 stocks highlighted today at 211 months. That's nearly 3 times as long as the streak from Zoetis. The worst 5-year return for Accenture was a mere 24.53%, and this was the 5-year period about 2 years after the financial crisis. For context, the 5-year rolling return for the S&P 500 at this same data point was minus 23%. The best return from Accenture was 275.6%, and on average it had a 5-year return of 125.82%. Its worst margin of outperformance relative to the S&P 500 was 6.41%, and this was the 5-year return following February of 2007. Its best margin of outperformance was 139.15%, and on average it beat the S&P by 62.49%. I'm sure there are other stocks out there that also have excellent winning streaks relative to the S&P 500. In total, I looked at 25 companies to come up with this list. The other 20 companies did not have perfect streaks, but they still performed very well. If you'd like to know who they were and what results they had, I'll leave a link to my newsletter below. The results for all 25 stocks were covered in the latest edition. Time will tell whether the excellent results these 5 companies were able to attain in the past will continue in the future. I have a long position in each of these companies, as I believe they are still great businesses, and I expect strong long-term returns from them. I think I'll keep tracking these results, just to see how long each of these companies can maintain this winning streak over the S&P. If you know of any other dividend stocks that have a perfect winning streak on a 5-year rolling return over the S&P 500, please let me know and I will add them to my list. Thank you for watching. Don't forget to like and subscribe to the channel. See you next time.